This is SFNet Presents In the Know with host Barry Bobrow, sponsored by Hilco Global.
Well, welcome to the second podcast in the Know series. I'm your host, Barry Bobrow. My guest today is David Silverman, Senior Director at Fitch Ratings. David's responsibilities at Fitch include all of the retail sector, and I think retail is a very important topic for the podcast and also for the audience that's listening to this. Mostly because retail represents the single largest exposure, single largest concentration in the asset-based market. There's a substantial amount of expertise that people have in retail, and that's throughout the cycle. So I think David's comments, especially given all this going on in retail, will be particularly timely, and I look forward to the discussion. Well, welcome to podcast number 2. And David Silverman is joining us. So first of all, David, thank you so much for agreeing to do this. I guess victim number 2 of the In the Know podcast. But I can't imagine anything more timely. I had the title "Retailing at a Crossroads," and then you added "as usual" to it. So I think we've got a lot to cover here. Retailing is a huge topic for the asset-based community, but it's also truly at a crossroads. We have inflation numbers coming out that we're going to talk about that. We have CEOs resigning or being kicked out at a number of the companies that are in the space, and I just think there's a lot to cover here. So looking forward to it. Let's get after it. David, before we start, I know you're a senior director, but can you just tell the listening audience, the watching audience, a little bit about what your practice is at Fitch and why we're having this conversation?
Yeah, great. Thanks very much for having me today. Looking forward to a good discussion. So Fitch Ratings is one of the big 3 ratings agencies, and I manage the retail practice, which is about 5 dozen or so U.S. and a few Canadian-based retailers. We are ultimately looking at and measuring the probability of default for retailers. I like to tell people that in some ways it's similar to an individual's credit score, if you will. We're just looking at things on kind of a letter scale. We look at companies, anything from well-performing companies like Walmart and Home Depot and Amazon to some of the more challenged players that we probably spend more time talking about. We have a mix of public ratings as well as we actually do a number of what we call private ratings of kind of mid-market companies that have private debt, and we work directly with asset managers to provide some analysis and ratings on those types of names.
And are those private ratings on a monitored? Are you updating them frequently, or is it a one-time rating?
No, we update those over time. We're working with the asset manager to get ongoing information, quarterly updates or changes, just the same as we would follow again a Walmart that's putting out Qs and Ks on a regular basis.
That's perfect, because it makes it clear that you've got a pretty broad purview over retail. And so let's jump into it. So, like I said, a lot going on. We have earnings season is upon us again, but the last earnings season didn't go particularly well. CEOs being fired, deals being canceled. We had just recently a couple of large public acquisitions that got canceled. The debt is trading at distressed or near distressed levels on a number of companies, along with the rest of the market, I guess. But from 30,000 feet, what would you say are the key factors that are impacting retail today, and how are you kind of looking at it from a rating standpoint?
Yeah, so I don't know how long this podcast is, David, yeah. But there's a lot in there, and maybe it's helpful to take a step back and for me to talk a little bit about how we've positioned our ratings as well as our viewpoints on how 2022 and 23 might play out. And this is these views have been true for the last kind of 6-9 months, but we've taken a look at the real strength that we've seen across retail over the last couple of years. I think my team is very familiar with the number that I like to quote, which is that retail sales ex auto and gas were up 20% in 2019 versus pre-pandemic levels, and that rising tide kind of lifted virtually every boat. We know all the factors: consumer behavior, spending more time at home, a lot of savings from not spending on services, travel, entertainment, government stimulus, and a relatively healthy balance sheet. Employment picture, et cetera. So we've had very, very strong retail sales. And frankly, as we've looked forward, even before we get to some of the issues around inflation, equity market declines, et cetera, we haven't felt that those gains were truly sustainable.
Right.
We thought that consumers would refocus their time and attention and, frankly, their budgets away from a lot of these goods categories and start respending on, again, travel, entertainment, et cetera. So we've modeled significant deceleration, if not declines, in overall retail volume levels as we approach kind of 2022 and 2023, and built our rating cases and our models around that. And frankly, we thought that would be okay. Typically, retail could grow, even a large retailer could grow sort of 2 to 3% a year. So to show some significant deceleration, if not declines, coming off of a 20% year, is to be expected. I know we'll get into inflation a little bit more. It's something that we're certainly watching. We're taking a somewhat, I don't know if it's a non-consensus view that we actually think that the consumer has caused a lot of the inflation that we're currently seeing by simply asking more goods to be put through the global supply chain over
more goods that a system was not really able to provide, right? Supply and demand.
Our global supply chain wasn't built for the type of throughput that we're asking it for. Plus, over the last year, companies are restocking shelves from 2020, and of course, we still have some ongoing challenges in some ports of origin with COVID lockdowns. We've got some labor challenges in various categories. That's how we're thinking about inflation. We're certainly thinking about a lot of the other factors that you've referenced. We have seen deal volume come down. Funny enough, that may or may not be a positive or a negative thing from a retail standpoint as we think about the implication of deals. We're certainly seeing, to your point, step up in turnover at the C-suite level. And I guess two things I'd point out. One is there are questions about how much a board would have wanted a C-suite to change over during a very tumultuous time over the last of years. So some of this could be kind of pent up. The other thing I think to point out that's interesting is retail is a pretty challenging sector. And before the pandemic, retail was the story of a number of large companies, particularly general merchants, e-commerce, and I think we know who I'm talking about, building and maintaining share. And there's been a real kind of challenge and a fight for a lot of the other companies across retail and across various spaces to maintain market share. And it's been a story of figuring out how you can develop and implement a model that really distinguishes yourself competitively. Over the last couple of years, there's been a rising tide kind of lifting all boats with retail sales being very strong. I think now what's happening is as some of these the numbers moderate and sales growth becomes a little bit challenging from here, we're now seeing some of the more kind of challenged retailers, if you will, get re-exposed, if you will. That may have been performing well over
the rising tide raised a lot of ships
that's
during the second phase of the pandemic. That's right.
That's right. And now we're seeing where there might be brand issues, operational issues that were maybe a bit obfuscated by the benefits that we saw from the pandemic over the last couple of years.
Yeah, for sure. And so I guess your point is that you built in a negative forecast, but it's probably exceeding your forecast too in terms of how tough it's been for a lot of the stores out there.
The negativity. I think that there have been a few cases where numbers are starting to maybe come in a little bit below where we were thinking. But I think on the margin and kind of on the whole, a lot of a lot of the sales figures, EBITDA, cash flow, et cetera, it still looks kind of in line to maybe even a little bit better than what we were thinking.
No, interesting. I like that.
Yeah, no, I don't know. I don't know if that sounds a little Pollyannish to you. I'd love your perspective. I think that the big wild card, at least for us right now, is inventory and kind of what happens to inventory, who's got too much.
I think that's right, David. I think that was sort of leading into the next question I had. But this is what we read about every day, is that the stores, maybe it's because they had such a good time in 20 and 21, or maybe because they just weren't able to see what was coming, but they find themselves with a mismatched and excess inventory. I know in talking with a lot of the banks that the good news is that the loans that they have are at a higher level. The utilization levels of the lines are quite a bit higher than they have been historically. On the other hand, there's just a lot of concern about the quality of the inventory and what will these retailers do with their inventory. So let me pose that to you. What do you think plays out here? Is it discount it and get rid of your problems as best you can now, hold on to it for a better day, or some combination?
Yeah, I think that it depends a little bit on the category and the type of inventory. When to step back a little bit, I think the biggest concern that we had coming into the year is we had this theory that consumer spending on goods would significantly slow down, if not turn a little bit negative. Our concern was that, what if companies didn't think that was the case and ordered too much inventory? And it does look like that concern has come to light, if you will, and we have a lot of excess inventory. I think that in the best possible case, and we seem to be seeing this with some of the retailers that are talking publicly, is they seem to be doing a mix of putting some away as pack and hold inventory, some of the seasonal inventory that they either got late or they ordered too much of. Could be pack and hold inventory, could sit around, but could be used as fresh inventory a year from now or whenever the next season comes up. Or a lot of them are just taking the pain now, getting rid of that inventory at deeper than planned markdowns. I think Target has probably been the best example of a company that's been very public about doing so. Perhaps the Gap with its announcement last week kind of indicated markdowns would be a bit higher. We think that others are doing the same. Our best case, if you will, and we did hear this from a number of companies kind of early in the year, is they recognized that there was this slowdown. And while they probably had too much inventory to take them through sort of the summer months, they seem to be where they could very quickly pulling back on inventory purchases into the fall. And as they start thinking about 2023, that's good. The fact that they're able to do that. A lot of these companies have been moving toward a model of buying closer to need and ordering closer to need with kind of tighter supply chains, forgetting what's happened with the supply chain over the last several years. So the ability to cancel orders should be a positive, should also help some of those supply chain issues. The last thing I would say on it is there's also a recognition of sort of what has more markdown risk and what doesn't have markdown risk, right? So apparel has markdown risk. Seasonal home, let's say patio furniture, that has some near-term markdown risk. But we're also looking at a lot of categories. Let's take home improvement as an example. If you order too much and tools or other kind of things within the home improvement category, you can sit on some of that inventory and be a little bit heavy on inventory as long as financing isn't a concern in the near term, and just pull back on your forward ordering and kind of let it sell off over time.
Yeah, David, you've got a wide spectrum of companies that you look at. You mentioned the large public companies and then the private companies, which I assume tend to be smaller. Do you think there's a difference in reaction to the inventory issue for a larger national profile company versus something that is smaller number of stores, more specialized?
I don't know that there's necessarily a large difference. I think that the larger the company, the better a position of power that they are in vis-a-vis vendors and other counterparties. And I think that what we saw, it wasn't necessarily talked about so much, but I think that what we saw in the pandemic is when a supplier, couldn't fulfill all of the orders and had to think about, okay, who am I going to disappoint?
Mm-hmm.
Is it going to be a large national chain retailer, or is it going to be one of these kind of smaller folks? I think you can guess who they might have chosen to disappoint. Yeah. So I wonder, some of these smaller folks may not have as much of an inventory. Perhaps may not have much of an inventory challenge. Like what was a problem last year? They didn't have enough. Now at least they're in the position of not having not having too much. Yeah, so I'd love to hear from you, Barry. Given the number of variables and kind of the uniqueness of the current environment, how are kind of financing entities these days thinking about the macro environment? Would they say that I'm way too Pollyannish and things are actually much worse?
No, I mean, I think your perspective is really interesting. I think it's consistent with the view that most of the companies that I would say have their capital structure is set. They don't have near-term maturities that are gonna cause an issue, and that they have lots of liquidity under their lines, whether it's an asset-based line or bank lines in general. So the companies that have liquidity and not any near-term maturity, because it would be problematic to refinance a bond or a term loan B given where the trading levels are. But if you don't have to, then you're fine, and you can make adjustments. I think where the banks are probably experiencing the biggest discussions is there is a concern, and I think we'll see it in bank earnings reports, which are coming out this week and next, that there's a lot of concern about what the credit environment is. That has to lead to banks taking a more cautious approach and maybe even downgrading internally, not your public ratings, but downgrading in the bank parlance. And so I think there's a line out there someplace where, if a company is going to be viewed by banks as a non-pass leveraged loan, which is a risk for a leveraged company, it's going to lose access, or may lose access, to a lot of bank financing. Which doesn't mean that it's the lights out, it's all over, but it does mean that banks won't be the solution. That it will have to be non-banks that can provide that additional liquidity if the companies need it.
No, that makes sense, and we think about that as well. I think that for us, as we think about where the real default risk might come in, it's ultimately who might have a liquidity concern, who might have a refinancing concern. Mm-hmm. And I think in the vein of what you're talking about, what's interesting within our coverage is that we don't have a lot of companies with real sort of near-term refinancing or liquidity concerns or questions. We saw a number of companies kind of early in the pandemic file Chapter 11, mm-hmm. Some of it being potentially an offensive Chapter 11 or a discretionary Chapter 11, as we've called some of them, and they've taken out some of the default risk that we would have thought that we would have seen this year, next year, et cetera. Mm-hmm. Are there kind of other than a specific maturity coming up or something like that? Are there kind of other ways that some of that risk or change in view on the part of a bank could end up impacting a retailer's kind of access to capital or
probably not. I mean, I think if you're an inventory lender, as most of the asset-based community is looking at it, the values are holding up. And the beauty of lending to retailers is that the goods will sell, unless it's something very exotic and or highly seasonal. The goods will sell at a discount, and usually, at least historically, that discount has been well in excess of where the lenders were lending. So you don't take a loss on lending against that inventory. You may have to hold the loan a little bit longer. I think what'll be interesting to see is we'll get through this year for most of the companies. When we get out into the first quarter of 2023, I think we're going to have much more visibility on the economic outlook. Banks will have a better view on credit, and you may see at that point companies having trouble accessing additional liquidity if the view from either the factors or from the banks is that this company needs to shore up their capital structure, or else we need to move on.
Yeah, I think that makes sense, and maybe what'll be helpful is as these companies hopefully start ratcheting down their inventory, their forward inventory purchases, their liquidity needs will actually kind of decline as well.
That's right. That's right. Self-liquidating through the inventory. Absolutely. Yeah.
Yep.
Yeah. So as you're looking forward into 2023, what's your forecast model telling you at this point? Because you were correct, not Pollyannish, but correct, I think, in looking at what's happening in 22.
Yes, we think that some of these flattening trends for retail are likely to continue. These flattening to kind of slight declines, will continue to 2023 as as consumers kind of continue to rebalance their budgets and their behavior more toward kind of a pre-pandemic mix of spending on services and travel and entertainment and all of those things. There's a hope perhaps on our part that some of the declines that we're seeing in inventory ordering could take some pressure off the supply chain. Hopefully we'll see fewer COVID lockdowns in points of origin than we've seen, although we've said that I think a number of times over the last couple of years, and that hasn't come to fruition. I think that we at Fitch are looking for kind of a flattening of GDP in 2023, with potentially some period of negative GDP in the U.S. for a couple of quarters, slightly negative. So it could be a very mild recession if there is one. We don't think that we're looking at a material kind of consumer recession. The health of the consumer continues to be quite strong, and is much stronger than you would typically think about at this point in the cycle, or kind of heading into a recession. So even if we were to see some economic stagnation, if you will. I'm not saying stagflation, but rather stagnation. We're not anticipating a material kind of downturn overall in consumer spending.
Interesting.
How are banks kind of thinking about some of these macro factors where you could have an economic stagnation, if you will, or flat to slightly negative?
I don't know. It's a great question, though. Probably like you said at the top, if we had a half an hour, I could give you a little bit more. But I think that banks are going to be very cautious, because that's how they approach something like this. And as a regulated entity, you've got to be worried about safety and soundness. And so I think that's inevitable that banks will become more cautious. I do think that in an asset-based format, banks have the opportunity to continue providing that liquidity if their overall strategy is consistent with that. And so I think that the banks will be supportive of the sector, because it's been a tried and true way to make loans that generally get paid back, if not weather companies through the cycle. Before time is short, I just wanted to throw one more question at you, David. So what, you mentioned it briefly, but, we've had this sort of, the omni channel is a consumer driven, do we buy in stores? Do we buy online? What can you tell us about the impact of the pandemic? Where do you think that the successful operators will be in terms of their mix of online versus in person? How is the consumer driving that?
Yeah, we've long thought that omnichannel is sort of the model of the future. I guess I should say model of the present now. And increasingly the consumer wants to be able to flip between channels throughout the process of throughout the purchase process, from research to shopping to where they're picking up the item to where they're conducting any sort of aftercare on the product, or return and exchange or service or something like that. So we view the best models as the ones that allow or the ones that are agnostic to how the consumer is shopping kind of across channels, with the caveat that it has to make sense given the company's brand and given the company's relationship with the consumer. And two of the strongest kind of omni-channel models that we see out there would be Nordstrom and Walmart as an example, but very different kind of customer bases, very different pricing, which lends itself to very different kind of mixes of convenience and service, et cetera. But we've we've long held that the omni-channel model, is incredibly important. And what's important about that is that the model is actually very expensive to build and maintain. The supply chain infrastructure that you need, the IT backbone that you need, the inventory integrity that's required. We've seen significant kind of CapEx increases and operating margin declines from a lot of these companies, and it's been somewhat challenging to watch from an operating model standpoint. But what I would note is it's another marker for us of what we like to call kind of the widening gulf between the winners in the space and the ones that are struggling. And there's kind of a virtuous cycle for leading companies that have strong market share, generate internal cash flow, and are able to invest in omni-channel features, et cetera, versus ones that are unable to do so and kind of fall further behind over time because they can't bridge that gap of consumer offering.
Yeah, and nothing like an economic down cycle to flush out the winners from the losers on that, because you have to continue investing in it or else it doesn't continue to grow. David, this has been fantastic. Thank you so much for taking time and for meeting with us. I'm sure we'll have this conversation again in a few months, and we'll have a great update for the holiday season. Thanks again.
Great. Thanks very much for having me.
Take care. Well, that was a great and I think very timely discussion with David Silverman of Fitch on the retail sector. Fitch has a very broad practice in retail, including both large public companies and also they do a series of private ratings for non-public companies, which gives him, I think, a terrific view of the entire sector. Retail is an extremely important sector for asset-based lenders, representing the single largest sector in most lenders' portfolios. And it's very dynamic at this time. And I think David highlighted several important considerations, including primarily the rapidly changing consumer behavior, concerns over potential for recession, and of course, inflation being the key drivers. When lenders to retailers, especially below investment grade, make loans, it's on a secured basis. They're heavily reliant on the valuation of inventory. So all the issues that David raised around the inventory issues being reported by retailers were extremely poignant. David's view from Fitch was that consumers remain very healthy despite the current challenges. And while their consumption patterns are changing, they're still purchasing, and they're willing to purchase if discounts are available. I think a very important point. We talked about the potential for distress, and I think David's key takeaway was that while there certainly will be some distress, the key drivers of that in the near term are really going to be, do the companies have sufficient liquidity, and do they have near-term maturities that might drive them to distress? And his view is that most of the retailers he covers do not have any of those issues. They have ample liquidity and they've dealt with their maturities, and so he does not expect a significant amount of distress, at least for the remainder of the year. And the last thing that David talked about was the development of the omni-channel. And I think he made a really important point, which is the omni-channel is still the target operating model. In other words, being able to service their customers both in an online and in a physical store presence. But that the current distress probably flushes out companies that have made the investment, which is significant, from those who have not been able to make the significant investment, and that he expects the gap to widen over the current period. Well, that concludes the second podcast in the In the Know series. Before we leave, I'd like to make sure I give special shout out to Hilco Global for agreeing to be the sponsor of the podcast. Without their support, none of this would be possible.